How does the new tax bill affect the taxation of my Social Security benefits? On July 4, 2025, a major tax bill was signed into law, officially called the One Big Beautiful Bill Act, or OB3 for short. Since then, one question has come up again and again for our clients. Are my Social Security benefits still taxable? I'm Mike Heatwall, founder and CEO of the Dollar Group, a wealth management firm focused on helping retirees. And in this video, I want to bring some clarity to that exact question. Shortly after the bill was signed into law, many U.S. citizens received an email from the Social Security Administration applauding the new bill. Here's a quote from that email. The bill ensures that nearly 90% of Social Security beneficiaries will no longer pay federal income taxes on their benefits, providing meaningful and immediate relief to seniors who have spent a lifetime contributing to our nation's economy. The email goes on to say, the new law includes a provision that eliminates federal income taxes on Social Security benefits for most beneficiaries, providing relief to individuals and couples. In addition, the White House issued a press release with the following quote. Under the One Big Beautiful Bill, the vast majority of senior citizens, 88% of all seniors who receive Social Security, will pay no tax on their Social Security benefits, according to a brand new analysis from the Council of Economic Advisors. I'm linking the White House press release in the description if you want to check it out. There's been some confusion because the public messaging doesn't exactly match what's actually in the bill. Despite headlines suggesting Social Security benefits are now tax-free, the OB3 bill did not change the taxation rules for Social Security. Instead, it added a new deduction for seniors that may reduce their total taxable income, but it doesn't change how Social Security benefits are calculated or taxed. So, let's dive into the three most important updates that were made in this bill for retirees. Change number 1. The 2025 standard deduction was increased. In 2025, the standard deduction increases to $15,750 for single filers and $31,500 for married couples. This reduces your taxable income automatically. And for many retirees, using the standard deduction is still the most tax-efficient option. Change number 2. Bonus deduction for seniors 65 plus through 2028. From 2025 through 2028, if you're 65 or older, you can receive an additional $6,000 per person on top of the standard deduction. But this bonus begins to phase out once your income exceeds $75,000 for single filers or $150,000 for married couples. That means a married couple over 65 who are under the phase-out limits could deduct up to $43,500 in 2025. Change number 3. The SALT deduction cap was increased through 2029. From 2025 through 2029, the cap on state and local tax deductions for households earning under $500,000 increases from $10,000 to $40,000. Now, this is especially helpful to those families who live in high-tax states and had previously been capped at the $10,000 limit when determining their itemized deductions. For example, in 2024, a couple in Illinois with $25,000 in property and income taxes was capped at $10,000. In 2025, under OB3, they can deduct the full $25,000 if their income is under $500,000. Of course, this only applies if you're itemizing your deductions instead of taking the standard deduction. Now that we've covered the new deductions, let's walk through 2 case studies showing how these updates interact with Social Security taxation and how they might impact your actual tax bill. So let's use Tom and Mary's sample as an example here. So Tom and Mary are married. They are both over 65. And what we're going to do is look at a scenario 1, which is before the bill, and a scenario 2, which is the same, using the same income, but after the bill. So in scenario 1, if I scroll down here, you'll see that we have $15,000 in total dividends, with a portion of those being qualified, IRA distributions of $45,000, taxable pensions and annuities of $12,000 a year, and gross Social Security of $60,000. Now, what you'll notice both before the bill and after the bill is that the taxable Social Security amount is the same, which goes back to my comment previously in the video as to the fact that the taxation of Social Security is not actually changing in this bill. But what does change, I will show you later on. So under total income, that remains the same, and adjusted gross income remains the same. Now where it changes is under the deductions. So for the standard deduction, Tom and Mary will go from $33,200 to $34,700. In addition, they each receive a $6,000 bonus deduction for seniors, equaling $12,000 total. That leaves us with a taxable income of $89,800 before the bill and $76,300 after the bill. This change results in a change in the taxation. So when we scroll down to the bottom, you'll see that the federal tax was $8,800 before the bill and is now $7,200 after the bill, resulting in a significant tax savings due to those standard deduction changes. Let's look at a second example. We're still going to use Tom and Mary. They're both 65 or over 65 and are married. So in scenario 1, what I'm doing now is I'm using the same numbers, but we're going to add in a Roth conversion. So before the bill, in scenario 1, you'll notice we have the same $15,000 in dividends, $45,000 in IRA distributions, $12,000 in taxable pensions and annuities, and now we're adding in a $25,000 Roth conversion, and then Social Security remains the same as it was before. So let's scroll down and look at the differences. Total income and adjusted gross income remain the same. The standard deduction changes from $33,200 to $34,700 like it did in example 1. In addition, the bonus deduction is added of $12,000. So the difference is in the taxable income, where we see $114,800 in scenario 1 before the bill and $101,300 after the bill. This change results in us moving from the 22% tax bracket down to the 12% tax bracket. And therefore, when we look at the total federal tax that's due, we owe $14,209 prior to the bill and $10,869 after the bill. So again, you can see the significant tax savings that's available there. Now, one of the things I wanted to look at so that I was able to show it to you is in scenario 3, I'm going to push that conversion higher so you can see what it looks like when we start to phase out of that bonus deduction. So I'm going to scroll all the way back up to the top, and you'll see that all the numbers are the same in terms of the dividends, distributions, taxable pensions, and Social Security. But the one change I'm making is I'm going from a $25,000 Roth conversion to a $50,000 Roth conversion for Tom and Mary. Now, by making that change, I've pushed our total income to $173,000, and adjusted gross income is the same, which is over the $150,000 phase-out limit for married couples. So what that does is that starts to phase out this special deduction. It goes from $12,000 down to $9,240. And by doing that, between the phase out in the standard or the bonus deduction plus the extra Roth conversion, we've pushed ourselves back into the 22% tax bracket. So now what that tax bill looks like is a $17,346 federal tax bill. If you found this video helpful, hit the like button and subscribe for more financial insights. Thanks for watching, and we'll see you next time. Once again, I'm Mike Heatwall, founder and CEO of the Dalla Group. If you are interested in seeing how we help our clients, visit us at www.thedallagroup.com. Give us a call or schedule a time to connect with one of our wealth advisors. We would love to hear from you.